So welcome to One-to-One Mining Investment APAC. We're now going to have our commodity-focused panel, where we have a lineup of analysts and investors who will be taking you through the range of commodities that are out there and telling you about what they think their picks are for the winners and losers at the moment and how COVID-19 is affecting the commodities market. We're delighted to welcome we have John Forwood, who is Chief Investment Officer at Lowell Resources Fund down in Melbourne. We have Clyde Russell, who is calling in from Tasmania. He is the Asia Commodities and Energy Columnist at Thomson Reuters. Here in Hong Kong, we have Helen Lowell, who's an Analyst, Metals and Mining Research at Argonaut. And we have Sophie Spartalis, who is Senior Equity Analyst at Bank of America Merrill Lynch. Down in Australia. So thank you very much for joining us today, panelists. I'd like to start, I think we'll start with Sophie. I'd just like to get your take on the situation at the moment regarding commodity markets. Are there any commodities that are benefiting is not a good word I'd like to use with such a terrible crisis, but are there any commodities that are on the upside at the moment?
Thank you for having me talk today. I think in terms of the commodities, there's been no commodity that hasn't been upturned from this COVID-19 outbreak. We've seen national lockdowns across the world. We've also seen companies having to adjust to this new operating environment. So I think, when we talk about the silver lining coming out of this this crisis, we're certainly getting a better focus on capital allocation. You look at Oz Minerals, they've taken 150 million of capex, they've deferred that, and now they're saying to the market that we probably won't be having to put all of that back in because they're looking at different ways and better ways of utilising that capital. We're also getting a better focus, I think, on costs and rosters and better ways of doing things because people are being forced to think outside the box. So I think that the market, the miners will definitely come out stronger at the end of this. There are certainly benefits from lower oil prices that we're seeing today. And also I think that there's a better morale amongst the miners as well in terms of productivity efforts, given they're just going to have to work a little bit harder for them. And I'm talking about harder in terms of mental strength as opposed to physical strength, because they're going to have to look at their operations a little bit differently. So look, it's obviously been a huge upturn to the industry, but I do think that we'll come out better.
And we've seen gold prices moving higher. What's your take on the gold market at the moment?
Yeah, so Bank of America actually revised up our gold prices quite significantly yesterday. We now have an 18-month target of $3,000 an ounce. That's an increase from $2,000 an ounce. Our commodity analysts who are located in New York and London really have upped our forecast given economic output contract sharply. We're going to have fiscal outlays surge. We're going to have central banks' balance sheets double. So, all that, will put fiat currencies under pressure, and we think investors will aim for gold. So, we don't see the world coming back or recovering sharply after this. We do see it's going to be a very long and sluggish return. And we probably won't get back to, the levels that we saw pre-COVID. So all of that suggests that it's a very bullish environment for gold. We've upped our forecasts in the short term, the near term, and also the long term.
But you're saying an 18-month target. So you're predicting economic disruption for a significant period of time.
Yeah, absolutely. Our global economics team has, negative GDP, really centered around the US recovery and the European recovery. We think it's going to be very slow and sluggish.
But what does that mean for the rest of the commodities suite? So copper, for example, traditionally economic growth is, fairly closely correlated to the copper price. What are your expectations there?
Yeah, so when you look at the base metals, end demand is generally 50% comes from China in iron ore and the bulks, you generally have, well, let's say iron ore, you've got 70% in demand coming from China. So, for example, in terms of copper, we've got a 25% increase from 2020 to 2022. So relatively modest recovery. But I think in terms of, any EV-related commodities will definitely have a slower recovery, given that's likely to be pushed out, that whole thematic.
Clyde, what's your take on the situation? Sophie there has predicted sort of, $3,000 gold. What are your thoughts on that?
Leo, I'd have to say, well, I am quite positive for gold over the short to medium term. $3,000 is a very, very brave call. You would have to be thinking that the recession that we're entering or already in is going to be very deep, very long, very horrible. And there's not much upside there. You also have to think that you're really going to see a lot of monetary easing, a lot of paper money being created and that sort of thing. I think all of those are reasonable. But the caution I always give for gold analysts is most of them are very Western centric and they don't really look too much at Asia. So they use their old models of basically gold as a function of US interest rates and the expectations around that. And what you're missing there is that almost 50% of the world's physical gold market is China and India. And if gold prices are going to $3,000, I will tell you now, it will absolutely crush physical demand in those two countries. So what you have to say, if you're going to be really, really constructive on the gold price, you have to say that the Western investor trade is going to be so big, it's going to overcome the loss of the physical buying or much of the physical buying in India and China. Now, I haven't actually seen that happen. When gold got to its record of 1925 an ounce, sort of 2011-12, at that point you had Western buying for investment purposes. You also had very strong India and China physical buying, and you had very strong central bank buying. In other words, the three pillars that support gold were all working at the same time. Right now, you've only really got the Western fear trade working as the main pillar. And that's enough to drive a reasonably good gold rally. But, I look at the numbers for India and China, their physical gold buying is collapsing. And that's quite a thing for gold to overcome. I would say that gold at 2,000 is certainly possible. 3,000 requires a whole level of pain that I would be reluctant to forecast yet. I do think that this recession we won't bounce back as fast as some commentators and analysts have hoped. I think it's going to be deeper and longer, and that will affect the commodity complex. But to get very, very bullish gold, I think you're assuming a whole range of things that there's not too much evidence for yet.
How hard is it, though, for you guys to be making predictions about commodity prices when so much of what happens next depends on decisions made by politicians and politicians who are, weighing up some scientific advice versus, possibly need to get the economy going again. And a country which opens up too early may, risk having a second wave of infections.
I mean, for me, I think predictions beyond the next few weeks are actually really hard, especially right now. What you can do is you can look at the trends, and you can say that so far, China's commodity demand has held up very well. That has been seen in iron ore, which hasn't fallen that much, coking coal, which is down a bit, but nowhere near as much as others. Even copper is starting to look a little bit constructive, although there's starting to be supply issues on copper mines closing. So, if you're a China-exposed commodity, then you're going to do all right. Crude oil being the obvious exception because the world demand for that is smashed. But if you are looking at, where are the opportunities in commodities, I would say exposure to China is actually your best bet at the moment. But the longer this goes on, the more likely more and more of the world economy will fall over. So you'll start to lose auto manufacturing, you'll start to lose a whole lot of things that use steel and the other base metals, and that will become a problem. I think the pressure on governments to open up their economies again, regardless of the health situation, will become overwhelming by June, July at the very latest. So what we're really we're in a race right now to see if we can actually beat this virus, or at least contain it, and then open us as much as the economy as we can. The big problem country is the United States. They're a very sort of hard to organize because of their federal system, their strong federal system, the great partisan splits we have there at the moment, and also, quite frankly, a healthcare system that's great for a small percentage of the population and rubbish for a large percentage. That creates problems. So, but the US is the world's biggest economy, and that's going to, how quickly they can recover, open up, and get back on their feet is really going to drive what happens to metals prices.
Helen, if we can bring you in here, Clyde there was quite sort of, I guess bullish on China. What's your take on what's happening in China? Obviously, here in Hong Kong, we're having some success so far, touch wood, on sort of controlling the virus. But in China, the figures obviously are disputed a little bit about their infections, but they seem to have things under control and are trying to get the economy back up and running again. What's your take on it?
Yeah, I think so far, if you look at the price recovery in base metals, I think it is certainly China-driven. There's some demand recovery there in China, and also there's supply issues. So I think China lifted this nationwide lockdown and resumed their production earlier, and so that has definitely is quite supportive for the commodity demand in general. But going forward, definitely there's risks for the commodity demand, especially from the rest of the world. And but at the same time, there's increasing supply issues. So overall, we start to see rebalancing in supply and demand fundamentals. So that's why you can see the copper, nickel prices have recovered. This is mainly because of the newly rebalanced supply and the demand situation. So the demand comparing to last year definitely is the demand growth is slower, but at the same time supply is also slow. Is also declining. So that is why we start to see a quick recovery in the commodity prices, especially in base metals. But going forward, further upside will depend on how fast the rest of the world recover, how fast they will be able to come back to normalcy. So this may not happen until the third quarter. So therefore, for us, it is pretty easy to make a short-term forecast from last month, when the prices, when a lot of commodity price has been declined so much, because we think at least that China is pretty good. There may be a short rebound, so that definitely happened. But then going forward, I think the quick rebound will not happen. I think it will consolidate at this level for some time until maybe third quarter we start to see some recovery. Yeah, that's it.
There are some interesting things, sort of coming out of this situation. I understand that in China, interest in purchasing a car has shot up now that people don't want to travel on public transport. Are there some sort of unexpected consequences of this pandemic that we might see, increasing demand in some areas?
Right, sure. But I think, as you know, the auto market only is a small part in commodity demand. So therefore, maybe there's a change in their habits in transportation. But so far, this is still have no big impact on overall commodity demand in China. And so I think in China, the commodity demand is still driven by infrastructure, construction, and yeah. So for that, fortunately, Chinese government have announced a lot of fiscal stimulus measures, and they will cut interest rate more. So definitely we expect to see more investment growth in infrastructure and more production in steel and in cement in order to meet the recovering in construction and like in the home in the retail estate sector.
Sure. John, if we could bring you in here now. Lowell Resources Fund obviously invests into junior mining companies. How do you as an investor play this market? What are the opportunities you're seeing? What are obviously there are lots of challenges as well.
Yeah, thanks, Leo. Yeah, look, it's a very difficult market, and as Clyde said, it's very hard to predict. You know, certainly more than a few weeks out. I'm not sure if anyone would have predicted that US oil prices would have gone negative just this week. So it's very tricky, but there are some interesting exposures that you can look at the moment. I think some of the niche ones, we obviously are pretty heavyweight into gold at the moment, and that's been very profitable for us of late. Particularly, it's been encouraging to see the explorers, the pre-production companies, if they make a big discovery, their share prices can really rocket. So there's a lot of money available for investment into junior companies and larger companies if they're doing well. But I think in terms of the niche commodities that are looking interesting, I think uranium is one that has probably performed the best so far in 2020, and that has seen quite a supply shock. We've seen the Kazakhs, which is basically the OPEC of the uranium space, shut down pretty much completely all their mines. We've seen a number of mines in Canada shut down, and we've also seen restrictions on Namibian production as well. At the same time, it is quite difficult to curtail nuclear reactors, and particularly in China, I think nuclear power is slightly up in 2020, certainly in the first quarter. So the uranium prices responded quite well, and there's some interesting opportunities in the uranium space that we are looking at the moment. So yeah, look, in terms of other commodities, we're quite interested in the PGM space. Alluded to the fact that low fuel prices and recession may really slow down the EV revolution, if you like, and interesting to hear about the move in China towards purchasing cars. If those cars are internal combustion engine driven, they need auto catalysts. We've seen supply out of the biggest PGM producer in the world, South Africa, really fall off a cliff, and that was happening already last year due to power restrictions. But a number of South African mines have been shut in as a result of COVID. So, things like palladium, where we've had a really interesting discovery here in Western Australia just recently by Chalice Mines, we are quite interested in the outlook for those prices as well.
Absolutely. Some of the companies you mentioned who've made some discoveries, well, you mentioned that some companies have made discoveries recently. Care to name any names?
Oh, look, the ones that we follow closely and have got exposure to, a company called De Grey Mining, which has made a big new discovery up in the Pilbara in Western Australia, which is looking like a multi-million ounce potential gold deposit. That that share price is probably up 7 times since last year. And then a company which has been active in West Africa for many years, called Predictive Discovery, made an exciting looking discovery in Guinea, and their share price has rocketed 10 times just in the past week. So that's certainly, they're both obviously in the gold space. Certainly encouraging to see investor interest. In times past, you may have put out an exciting, drill result, and just been an excuse to sell the shares to be sold off. But at the moment, there's certainly a lot of interest in the gold exploration space.
It's interesting what you said about uranium as well. I mean, why have the Kazakhs been shutting down their mines? Is it because of COVID fears?
Look, they had already implemented, I think it was a 20% reduction over the 3 years to 2022 prior to COVID. And then as a result of COVID, I think, they've had quite a few cases relatively. And as a result of COVID, I understand they've shut in pretty much all their mines. Right,
absolutely. You mentioned EVs, and this has come up in a couple of comments here. Going forward, and this is wildly theorising about the future, but given that people are now, more willing possibly to listen to scientists and to heed their predictions after we've had some fairly disastrous results of people not listening to scientists' predictions. If we look at climate change going forward and scientists' predictions that we need to be doing, and recommendations that we need to be doing stuff now, do you think we're going to be seeing more interest in EVs and maybe fuel cell vehicles as we emerge from this current situation?
Look, I think, if there's a recession and if you're a driver of a car who hasn't got a job and, fuel price might be, half of what it was at the petrol pump, last year, I think you're going to opt for, internal combustion, gas guzzling car over an EV, for the next at least midterm.
So you think it's going to come down to economics?
Absolutely.
Any of the other panelists have a thought on the future of EVs? Obviously, it's been such an important space in the mining industry of recent years. Clyde, what's your thoughts on this?
I would agree that the immediate effect of cheap petrol prices and cheap diesel is that it's going to make those type of cars more popular, or certainly easier to hang on to. But I think we maybe should focus a little bit more beyond just EVs when we're talking about what might change in the future. And there's a lot of pressure being put on for a lot of the stimulus spending that will be coming to be flowing into renewable energy projects. So you're looking more at more wind farms, more solar panels, more kind of batteries, that kind of thing. Now, I'm not saying that's necessarily enough to offset slower EV sales, but it is quite interesting. And it might stoke some demand because a lot of these things are fairly heavy on the base metals and copper. So, that might stoke some demand for them if that comes to pass. Conversely, it's very negative for coal and possibly also for LNG. But I think there's a lot of pressure coming. I can see it, that the renewable energy sector is very much angling to get a much bigger slice of stimulus spending. That's going to be not just, it's going to be quite widespread around the world. And that could actually drive quite a significant change in just sort of what commodities are needed.
Absolutely. I mean, when we talk about stimulus spending, there's obviously a lot of packages around the world being announced. Where are we going to see this making the most impact in the commodity space? Sophie, what are your thoughts on that?
Yeah, it's a tough question. In terms of government spending, look, I don't think we're going to get any relief. I think if anything, there's going to be upward pressure on royalties to pay for a lot of these stimulus spending. So I think we're going to have, quite an inflationary environment. I actually see it's going to be quite negative for the cost base for the miners, and they'll continue to have a very big focus on cost outs. Particularly if, particularly with gold companies, if the gold price is going up, the states always want a piece of that through royalties. They've tried a number of times in Western Australia to increase the gold royalty. That's failed. But I think that, I think governments around the world are going to be grabbing for any type of revenue that they can possibly get. So I think we'll see a review of a lot of these taxes.
I think also if your prediction comes true and gold is $3,000, we saw in the last time the gold price went up to sort of 1900, suddenly governments around the world became very interested in getting royalties from mines in their jurisdiction. Are we going to see the same situation?
Yeah, absolutely. I think that, look, what we generally see is the cost base of the miners does rise with the gold price. So you don't see margins significantly expand when you do have, any commodity price, skyrocket upwards. But absolutely, I think all governments around the world, will either try a nationalism type of approach and want more equity in the projects, or they'll try and up the royalty arrangements.
But at the same time, you'll have lower fuel prices. So for projects which require a lot of fuel input, that would be good for their costs, I guess. Yeah,
but when you look at the longer term trends, though, that we're certainly heading more underground than open pits. So the diesel factor really comes into these very large open pits. Any greenfield type of development generally is going underground, particularly in the gold space anyway. So I think that the diesel component, yes, it certainly helps in some regard, but I don't think it's going to really move the needle.
But if you've got something like a big iron ore mine or something like that, and Clyde mentioned earlier that, China's probably going to be first out of this sort of crisis, and they're going to be spending a lot on infrastructure. So probably more iron ore demand, but lower fuel costs.
Yeah, absolutely. For the iron ore miners, absolutely, any lower diesel costs will be obviously beneficial for their production costs, but also for their shipping costs as well. So that gets sold sometimes on a CFR basis. So particularly for Brazil, that will have a huge benefit for Vale. When I talk about the move going underground, that's more for the gold base metal mines. We see a lot of the newer greenfield development projects being underground, and so you won't get that benefit from the oil price.
Absolutely. So as a sort of final wrap-up question for you, what should we all be doing right now? I mean, what should we be? Where should we be looking to put our money, or should we be just sticking it under the mattress and doing nothing? Because there are people out there who will say, if you don't understand what's going to happen next, you should do nothing. So, but obviously, if we do nothing, that causes its own problems. So what should we be doing next? Where should we be looking for opportunities? Where should we be looking for challenges, or where will we be seeing challenges?
Yeah, so for me, given the higher gold price forecast, we've just pushed through a lot of upgrades in terms of earnings as well as recommendations. So, we have buys on all our gold stocks, as the other panelists were saying, when you've got exploration potential, good management, good quality assets, low cost base, that strong cash flow generation will come through. So really, I think it's in these kind of uncertain times, it's always good to stick with quality. And then in terms of, the copper exposures, we still like that, as we heard as well. China seems to be recovering, steel utilization rates have recovered very well. And so we still like those names as well. In terms of the iron ore mines, though, we do forecast that iron ore prices will come down to around $65 a tonne by the end of this year. So there is some caution there. So we at the moment still prefer the base and precious metal exposures.
Fantastic. Helen, what are you telling your clients to do?
I think in terms of stocks, right? I think the commodity space is still the place to be. I think it is still better to have some risks, to take some risks there, and especially given so much liquidity. Yes, maybe this will benefit gold, but because of this increasing risk on sentiment, a lot of these undersold commodity stocks will also benefit. That is in general the overall general comment. And in terms of company recommendation, definitely we still prefer the one has a very good, solid balance sheet, the one that has comparative that just has strong cost competitiveness and has a lot of diversification. So even though the price may be volatile going forward, but they will still be able to generate a strong cash flow. And then if you look at the valuation comparing to other sectors, so there's some quality commodity stocks that stand out. And then in terms of commodities, we think from my perspective, I think there will be there will be still some upside. Surprisingly, in nickel, we have been bearish on nickel, but we start to see more and more supply risks there in nickel, and also in uranium, as John also have mentioned before. We're also quite positive on the uranium prices going forward because of these supply risks, and the copper as well. So certainly, like a few weeks ago, we talked about China recovery, but now I think over the short term, I think we start to focus on the supply risks that in outside China. So that is me sort of.
Are those supply risks all COVID related?
Yes, mostly COVID-19 related, but there's some regulatory and weather related, like Lowell. So that is something that I think markets or investors should focus on. So therefore, we think there's still a lot of opportunities. As for gold, I think it does not matter. For us, we are really rather neutral about gold prices, but definitely there's a lot of interesting gold stocks in Australia because their cost is very low, and in terms of Australian dollar, the gold price is very high. So therefore, a lot of good quality gold companies there. But the reason why we are quite neutral about gold price outlook, as we mentioned, we think certainly there will be fund inflow back to base in other commodities, right, and in other commodity stocks. So, and also in terms of a physical demand, at this stage, a lot of Chinese actually go to property market instead of to buy a lot of gold. Given that Chinese government has injected a lot of liquidity to the market, but we see a lot of funds going to the real estate market instead of to buy a lot of gold. So therefore, we do not see substantial demand recovery in physical gold yet in China, and so that's why I'm not especially excited about overall physical demand for gold, and the investment demand for gold may be partially maybe strong, but as I mentioned, maybe there's a lot of fund also wanted to invest in other oversold commodities, right? So
of course that interest might come back once they've read Bamel's report.
Yeah.
Clive, Sophie and Helen there had some sort of, green shoots, opportunities there. What's your take?
Honestly, Leo, I think it's hard at the moment to be positive for anything until I start to see the world economy coming out of its sort of lockdowns. Yes, there are some green shoots in China, but China alone can't rescue every commodity, although it can certainly support your iron ores, your coking coal, those to some extent your copper and nickel, those kind of commodities. I think what Helen was on about, that we must look at supply very carefully. So far, there's actually been very little disruption to mines from the coronavirus. I think the risk is that some more get shut down. I mean, John was talking about uranium. The spot uranium price has surged in the last few weeks, and that's entirely on the back of Kazakhstan shutting. So there are those little kind of weird opportunities that pop up every now and again. But overall, the only certainty I would say at the moment is gold. I don't think you're going to lose money buying gold. You might not make as much as some hope, but it's probably a safe place to park your money. The rest of the time, I think you're looking for a bottom in the market. You start to see restrictions being eased, then you might say actually we've now hit the bottom. but it's probably going to be a long, slow recovery, which will take several years. If you look at the great financial crisis, 2008, the recovery really only picked up momentum in 2010, 2011. And that was on the back of some major stimulus spending as well, led by China. Yes, we're going to get a huge amount of stimulus spending, and that should in turn drive demand. But at the moment, on the short term, I'm more interested in looking at supply disruptions. But I think to pile into actual buying physical commodities, you've got to wait till you start to see things turning. And unfortunately, we're not there yet. Another month, maybe, but we're not there yet.
But coming out of the GFC, the miners were sort of leading the charge as markets recovered. John, I guess you're putting your money in gold at the moment. Is that right?
Yeah, look, we are overweight in gold. We have been for quite some time. Just the niche that we really like in gold at the moment for a number of reasons is Australian gold projects which are within striking distance of existing infrastructure, and by that I mean hungry plants and hungry mills. And I guess that striking distance becomes longer as a result of the fall in the fuel price, that you can truck ore further and further. But these gold miners in Australia, as I think Sophie alluded to, are making very good money at the moment. They are going to find it hard to go and make M&A acquisitions overseas because just of the simple travel restrictions of sending due diligence teams to far-flung places. Australia has been lucky, if you like, that the government has largely left the mining industry intact, and that also applies to the exploration side of things. That many exploration projects have kept drilling and kept results coming. So I think you're going to see, if there is M&A in the gold space, you're going to see that happening, close to home, if you like. And these Australian gold miners who are stacking away lots of cash at the moment will be looking to spend that, and they'll be looking to spend that on projects close to home.
Absolutely. Well, despite the situation, I think you've all painted an interesting picture there with opportunities as well as challenges. We'll all obviously have to wait and see how this all plays out over the coming weeks, months, and years. But thank you very much all for joining us here today, and best of luck for the year ahead.
Thank you.
Thanks,
Thank you very much.